Okay, well, as you know, we don't own the FANGs. Netflix, we think, is a question of dubious value, and we don't own Netflix, right? But you mentioned Google. We do own Google. We have owned Google for a long time. And if you look at the fact that something like 80% of its revenues are derived from advertising, we really think it's an advertising company basically, and and so it can be measured in more conventional fashion. So, we think Google is ever present. I mean, when you want to find the name of the local pizza store, and you don't know where you go, who do you go? You go to Google, right? So it's such a dominant franchise. Revenues derived from advertising. So we still have a significant size in Google. Yes, that's correct. Berkshire Hathaway sells at about 1.4 times book value today, right? Which is not extraordinarily expensive. We still think the culture of Berkshire Hathaway is great. Buffett has something like $1.3 billion on the balance sheet, which can be used to make a large acquisition one of these days. And if we ever get a correction in the market, he'll probably do that. And in the meantime, we regard Berkshire as a collection of really great individual companies like Precision Castparts or Geico Insurance, which we used to own. We like his equity portfolio also. And who can beat Buffett in terms of an asset allocator of capital? So we still have a significant position in Berkshire Hathaway. We think if the market declines, which it might one of these days, who can forecast, Buffett said that he would be a big repurchaser of his own shares should the market decline. And that would be a very defensive thing for the fund to own. So yes, we still love Berkshire Hathaway. It's a large company. The bigger you get, the harder it is to make your money grow. That's true, that's a negative, but we think at 1.38 times book value, Berkshire is still reasonably valued and it has very, very good downside protection should the markets ever correct. Mondelez, MDLZ is the symbol. Mondelez is a company we recently bought a position in. It's a company that was spun out of Kraft years ago. They make such things as Oreo cookies and biscuits. It's a snacking company, right? It's a snacking company. It has very modest organic growth in the United States, but it sells at 14 times earnings. Something like 35% of its sales are in emerging markets, which are still growth vehicles. And it's also possibly a takeover candidate for Kraft Heinz. It has new management, which we like. It's a new Irene Rosenfeld, the former CEO, left the company, has a new manager which we like, who is also thinking about strategic options in the company, and they may do certain things like get rid of the gum business, which has been underperforming. So the positives for Mondelez are it's got a reasonable multiple, it's 14 times earnings, could be a takeover candidate, and it's in high growth categories like snacks, which are still very high growth categories, especially in emerging markets. So Mondelez is a company we still like. And companies we've added to recently are TJ Maxx, which is an off-price discount retailer, O'Reilly Auto Parts, which is an auto parts company, Wells Fargo we've added to on weakness and some controversy, and even Phillip Morris, which has had controversy in the tobacco space, we've added to recently. So we've added to plenty of companies in this space. That's good. Yes, we've been concerned about valuation in the U.S. stock market for a long time, but I think, as Buffett has said, the nature of the economy and the nature of the market has changed. The market, because of companies like, so when you look at conventional valuation metrics like price to earnings ratio, price to book, the market has looked expensive for quite a while. But something has changed in the nature of the U.S. economy and how it works, which affects valuations. As Buffett said, companies like Amazon, Google, Facebook are asset light. They don't need many tangible assets to grow, And I think this affects how we look at the markets. So if you look at conventional metrics like price to earnings ratio, price to book, the market has looked expensive for years, but keeps going up and up. Maybe the way we need to look at the market has changed because the companies that dominate the market today are not like old manufacturing companies like General Electric or Ford Motor Company. They're companies like Google and Amazon, which rely on intellectual capital, not tangible assets. And hence I think you have to look at the way you value the market differently. In that respect, our humble opinion is the market's probably fairly to richly, fairly to generously valued. It's probably not grossly overvalued, but I think the companies we own, if you look at them, they sell at multiples that are reasonable relative to the market, but as our portfolio as a whole offers a return on equity that's greater than the market with lower business risks. So our portfolio is not the market. We only have 30 to 40 names in the portfolio. We don't have 500 names. So while we may think about the market, we think our portfolio is always very, very different from the market. It offers attractive returns with lower risk than the market, and that's what we offer our clients over the long run.